a few days. I am happy to note that the Indian economy is exuding enhanced strength and stability despite the massive shocks to the global economy in recent years. Our economy has continued to grow at a reasonable pace, becoming the fifth largest economy in the world and contributing around 15% to global growth. We have also made significant progress towards controlling inflation. Our banks remain healthiest in more than a decade, with historically high levels of capital, declining levels of non-performing assets, and rising profitability. Corporate balance sheets are robust with lower leverage, improving debt servicing capacity, and strong profitability. Lower current account deficit and ample capital flows have imparted strength to our external sector, the foundations for sustainable growth. In a moment like this, we need to continue with our efforts to maintain macro-financial stability while pushing our growth frontier further. India is uniquely placed to benefit from the ongoing transformational shifts in the global economy in the wake of geopolitical realignments and technological innovations. A large economy marching ahead with vast domestic demand, untapped resources, and demographic advantages, India can become the new growth engine for the world. In this background, the Monetary Policy Committee met on 8th, 9th, and 10th of August. After detailed deliberation on all relevant aspects, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely against the backdrop of a skewed southwest monsoon so far. These developments warrant a heightened vigil on the evolving inflation trajectory. The cumulative rate hike of 250 basis points undertaken by the MPC so far is working its way into the economy. Nevertheless, domestic economic activity is holding up well and is likely to retain its momentum despite weak external demand. Considering this confluence of factors, the MPC decided to remain watchful and evaluate the emerging situation. Consequently, the MPC decided to keep the policy repo rate unchanged at 6.5% with preparedness to act should the situation so warrant. The MPC remains resolute in its commitment to align inflation to the 4% target and anchoring of inflation expectations. Further, with monetary transmission still underway, and I have given some details in the footnote of my statement with regard to this. When I say monetary policy transmission is still underway, there are some additional information given in the footnote. Those of you who are interested may have a look at it. Further, with monetary transmission still underway and headline inflation remaining higher than the 4% target, the MPC decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now like to provide our assessment of the growth and inflation scenario. First, I would like to take up global growth. The global economy continues to face daunting challenges of elevated inflation, high levels of debt, tight and volatile financial conditions, continuing geopolitical tensions, fragmentations, and extreme weather conditions. Belying earlier apprehensions, a number of economies have demonstrated remarkable resilience, and the grim prospects of hard landing appear to have receded. Nevertheless, global growth is likely to remain low by historical standards in the current year and also in the next few years. Despite upward revision in the global growth forecast for 2023 by the International Monetary Fund. World merchandise trade volume growth is projected by the WTO to decelerate from 2.7% in 2022 to 1.7% in 2023. Headline inflation is easing unevenly across countries and remains above the target in major economies. While the pace of monetary tightening has been scaled down, policy rates could stay higher for longer. Financial markets, which had been buoyed by expectations of an early end to the cycle of monetary tightening, have turned volatile with sizable two-way movements in response to recent rating events and incoming data. Turning to global growth, these external factors are likely to impinge on the growth prospects of most advanced and emerging economies. India is, however, expected to withstand these external headwinds far better than many other countries. The momentum of overall economic activity in India continues to be positive. On the supply side, crop sowing has picked up with steady progress in the southwest monsoon. The temporal and spatial distribution of monsoon has, however, been uneven. Industrial activity is holding ground, as is evident from the latest data on Index of Industrial Production, that is IIP, Core Industries Output, and Purchasing Managers Index, that is PMI for manufacturing. Buoyant services activity is reflected in healthy expansion in e-way bills, toll collections, railway freight, and a sharp jump in services PMI. On the other hand, commercial vehicle sales and domestic air cargo traffic contracted during Q1 of the current financial year. Aggregate demand conditions continue to be buoyant. Among urban demand indicators, domestic air passenger traffic, passenger vehicle sales, and households credit are exhibiting sustained growth. In the case of rural demand, tractor and fertilizer sales improved in June, while two-wheeler sales moderated. High growth in agricultural credit and improving sales volume of major fast-moving consumer goods, that is FMCG companies, suggest incipient recovery in rural demand, which will be reinforced by improving Kharif prospects. So what I have done under growth is that first I highlighted about the supply conditions, the supply side factors. Then I have highlighted the aggregate demand conditions consisting of both rural and urban demand. And let me now turn to investment activity. Investment activity gained further steam on the back of government capital expenditure, rising business optimism, and revival in private capex in certain key sectors. Continued increase in import and production of capital goods further reaffirms this trend. Construction activity also remains strong in first quarter of this year, as indicated by healthy growth in cement production and steel consumption. Capacity utilization in the manufacturing sector at 76.3% remained above the long period average, remained above the long-term average of 73.7%. The total flow of resources to the commercial sector from banks and other sources taken together has increased by rupees 7.5 lakh crore during the financial year 23-24 so far, that is up to July 28th, as compared with 5.7 lakh crore a year ago. So just to repeat the figures, the flow of resources to the commercial sector in the current year so far is 7.5 lakh crore, and in the corresponding period of last year it was 5.7 lakh crore. On the downside, however, merchandise exports and non-oil, non-gold imports contracted further in June, and the growth in services exports decelerated amidst slowing external demand. Looking ahead, these underlying developments and the upcoming festival season are expected to provide support to private consumption and investment activity. The spillovers emanating from weak external demand and protracted geopolitical tensions, however, pose risks to this outlook. Taking all these factors into consideration, real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6%, and Q4 at 5.7%. Real GDP growth for Q1 of next financial year, that is 24-25, is projected at 6.6%. The risks are evenly balanced. Let me now turn to inflation. The moderation in headline inflation to 4.6% in Q1 of 23-24 was in line with the projections set out in the June MPC meeting. There was pickup in headline inflation to 4.8% in June due to an upturn in food inflation. On the positive side, inflation excluding food and fuel, that is core inflation, has softened by more than 100 basis points from its recent peak in January 2023. The month of July has witnessed accentuation of food inflation, primarily on account of vegetables. The spike in tomato prices and further increase in prices of cereals and pulses have contributed to this. Consequently, a substantial increase in headline inflation would occur in the near term. Going by the past trends, vegetable prices may see a significant correction after a few months. The prospects of Kharif crops have also brightened thanks to improvement in the progress of the monsoon. Uncertainties, however, remain on domestic food price outlook due to sudden weather events and possible El Nino conditions in August and September. August and beyond. Global food prices are also exhibiting a hardening bias on renewed geopolitical tensions. Crude oil prices have firmed up in the recent weeks, and its outlook is clouded by demand-supply uncertainties. Assessment of the future trajectory of inflation is a continuous process. We have a choice to modify our inflation projections in every meeting of the MPC if warranted, in the interest of better guidance, or avoid frequent changes and revise them only on fewer occasions for simplicity of presentation. Given the continuing uncertainties, our latest CPI inflation projection for 2023-24, assuming a normal monsoon, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Let me just repeat these numbers for better clarity. CPI inflation projections for 2023-24, that is for the current year, assuming a normal monsoon, as I have said, is revised to 5.4%, with Q2 at 6.2%, Q3 at 5.7%, and Q4 at 5.2%. Further, CPI inflation for first quarter of the next financial year, that is 2024-25, is projected at 5.2%. The risks are evenly balanced. Headline inflation projection for the second quarter of 23-24, that is, for the months of July, August, and September this year, has been revised up substantially, primarily due to price shock from vegetables. Given the likely short-term nature of these shocks, monetary policy can look through high inflation prints caused by such shocks for some time. The frequent incidences of recurring food price shocks, however, pose a risk to anchoring of inflation expectations, which was underway and which has been underway since September 2022. The role of continued and timely supply-side interventions assumes criticality in limiting the severity and duration of such shocks. In such circumstances, it is necessary to be watchful of the emerging trends and the risks to price stability. We have to stand in readiness to go beyond keeping Arjuna's eye to deploying policy instruments, if necessary. I reiterate what I said in the previous June policy statement. Bringing headline inflation within the tolerance band is not enough. We need to remain firmly focused on aligning inflation to the target of 4%. With this, I would now like to take up the liquidity and financial market conditions. The level of surplus liquidity in the system has gone up in the recent months on the back of the return of rupees 2,000 banknotes to the banking system, RBI surplus transfer to the government, pickup in government spending, and capital inflows. The overall daily absorption under the Liquidity Adjustment Facility, that is LAF, was 1.7 lakh crore in June and 1.8 lakh crore in July this year. Despite such surplus liquidity, market response to RBI's 14-day variable rate repo auctions, that is VRRR auctions, was lukewarm. Instead, banks preferred to place their surplus liquidity in the less remunerative standing deposit facility, that is SDF. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market. This essentially, let me just read it again. Although the fine-tuning VRRR auctions of 1 to 4 days maturity during this period evoked better response from the market, this essentially reflects greater risk aversion among the banks to park large funds under the main operation. In this context, it is necessary to reiterate that fine-tuning operations, that is overnight operations up to 13 days, are undertaken to deal with special or exceptional situations and cannot become a rule. In recent years, our stated stance on liquidity is to maintain adequate liquidity in the system to meet the productive requirements of the economy. Excess liquidity, on the other hand, can pose risks to price stability and also to financial stability. Hence, efficient liquidity management requires continuous assessment of the level of surplus liquidity so that additional measures are undertaken as and when necessary to impound the element of excess liquidity. Accordingly, it has been decided that with effect from the fortnight beginning August 12, scheduled banks shall maintain, I repeat, scheduled banks shall maintain an incremental cash reserve ratio, that is ICRR, of 10% on the increase in their net demand and time liabilities, that is NDTL, between May 19th and July 28th. I would like to read this sentence again so that the message gets across. It has been decided that with effect from 12th of August, scheduled banks shall maintain an incremental CRR, that is ICRR, of 10% on increase in their NDTL between May 19th and July 28th. And what I am now going to say is equally important. This measure is intended to absorb the surplus liquidity generated by various factors referred to earlier, including the return of rupees 2000 notes to the banking system. This is purely a temporary measure for managing the liquidity overhang. Even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. We have reviewed the position, and on that basis alone, on the basis of our internal assessment, I am making this statement that even after this temporary impounding, there will be adequate liquidity in the system to meet the credit needs of the economy. The incremental CRR will be reviewed on 8th September or earlier with a view to returning the impounded funds to the banking system ahead of the festival season. I must add that the existing cash reserve ratio, that is CRR, remains unchanged at 4.5%. I would now like to focus on financial stability. The Indian financial sector has been stable and resilient as reflected in sustained growth in bank credit, low levels of non-performing assets, and adequate capital and liquidity buffers. Macro stress tests for credit risk reveal that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress scenarios. There is, however, no room for complacency, because it is during tranquil and good times that vulnerabilities may creep in. Hence, buffers are best built up during these periods. A stable financial system is a prerequisite for price stability and sustained growth. This is a shared responsibility in which regulated entities like banks, NBFCs, and others are important stakeholders. On its part, the Reserve Bank remains steadfast in its commitment to safeguard the financial system from the emerging and potential challenges. We expect the same from the regulated entities also. As regards the external sector, India's current account deficit was contained at 2% of GDP in 2022-23 as compared with 1.2% in 2021-22. Merchandise trade deficit has narrowed in the first quarter of the current financial year, that is 23-24, with contraction in imports exceeding contraction in exports. Services exports and remittances are, however, expected to provide cushion to the current account deficit. We therefore expect the current account deficit to remain eminently manageable during the current financial year also. On the financing side, foreign portfolio investment, that is FPI flows, have remained buoyant in 2023-24, that is in the current year so far. Net FPI inflows have been $20.1 billion up to August 8, which is the highest since 2014-15. In the corresponding period of the previous year, there were net outflows of $12.6 billion. The inflows under external commercial borrowings also witnessed a turnaround, with net inflows of $6 billion during April-June this year, as against net outflows of $2.9 billion a year ago. Net foreign direct investment, that is net FDI flows to India, on the other hand, fell to $5.5 billion during April-May 2023 from $10.6 billion a year ago, reflecting a global slowdown in FDI inflows or in FDI flows. Latest available data suggest that India's external debt to GDP ratio improved to 18.9% at the end of March 23 from 20% at the end of March 2022. The Indian rupee has remained stable since January 2023. Foreign exchange reserves have crossed the mark of US 600 billion. The umbrella has gathered strength, and I am not saying this in the context of the monsoon rains. I would now like to proceed and announce certain additional measures. As you would be aware, we announced several measures as a part of the MPC statement, and a number of these measures have very far-reaching consequences, and they make a lot of impact on our overall financial inclusion, on our financial, on deepening of credit, on the spread of UPI, and on other aspects of the economy. So we have a few measures. I request your continued patience. The first announcement relates to review of regulatory framework for financial benchmark administrators. It has been decided to revise the extant regulations issued in June 2019 and put in place a comprehensive risk-based framework for administration of financial benchmarks. This will cover all benchmarks related to foreign exchange, interest rates, money markets, and government securities. The revised directions will provide greater assurance about the accuracy and integrity of the financial benchmarks. The next announcement relates to review of regulatory framework for infrastructure debt fund NBFCs, that is IDF NBFCs. At present, infrastructure debt funds provide refinancing facilities for lenders in the infrastructure sector. The extant regulatory framework for IDFs has been revised. The key changes in the revised framework are: 1. Withdrawal of the requirement to have a sponsor for the IDFs. 2. Allowing IDFs to finance toll operate transfer, that is TOT projects, as direct lenders. 3. Permitting IDFs to raise funds through ECBs. And 4. Making tripartite agreements optional for PPP projects. These changes are expected to further augment the capacity for infrastructure financing in the country. The next announcement relates to greater transparency in interest rate reset of equated monthly installments based floating rate loans. Now let me just read it again, I think that was too long. The next announcement relates to bringing in greater transparency in interest rate reset of EMI installment based floating interest loans. It is proposed to put in place a transparent framework for reset of interest rates on floating interest loans. The framework will require regulated entities to, again there are various components, it will require the regulated entities to, number 1, clearly communicate with borrowers for resetting the tenor and or the EMI. Number 2, provide options for switching to fixed rate loans or foreclosure of loans. 3, disclose various charges incidental to the exercise of the options. And 4, ensure proper communication of key information to the borrowers. These measures will further strengthen consumer protection. The next announcement relates to consolidation and harmonization of instructions for supervisory data submission. The Reserve Bank has from time to time issued several guidelines on submission of supervisory returns by the supervised entities. It has been decided to consolidate and harmonize such guidelines into a single master direction to reduce compliance burden and to promote greater ease of doing business for supervised entities. And the next announcement, actually there are 3 announcements within this announcement, and it relates to UPI. And basically the announcements are related to bringing in conversational payments and offline capacity on the UPI, enhancement in transaction limit of small value offline digital payments. The details are as follows. With the objective of harnessing new technologies for enhancing the digital payments experience for users, it is proposed to, number 1, enable conversational payments on UPI, which will enable the users to engage in conversation with artificial intelligence powered systems to make payments. Number 2, introduce offline payments on UPI using near field communication technology through UPI Lite on device wallet. And number 3, enhance the transaction limit for small value digital payments in offline mode from rupees 200 to rupees 500 within the overall limit of rupees 2000 per payment instrument. These initiatives will further deepen the reach and use of digital payments in the country. And this is the final announcement, the next one, and it's really impactful. We expect this announcement going forward will have a huge impact on our credit sector. The Reserve Bank, in association with the Reserve Bank Innovation Hub, started a pilot project in September last year for frictionless credit delivery through end-to-end digital processes, starting with Kisan Credit Card Loans, that is KCC loans. The pilot for KCC loans is currently operational in select districts of Madhya Pradesh, Tamil Nadu, Karnataka, UP and Maharashtra. Recently, dairy loans have been included in the pilot project in select districts of Gujarat. Based on the learnings from the pilots and to expand the scope of end-to-end digital lending processes, a public tech platform for frictionless credit delivery, I repeat, a public tech platform for frictionless credit delivery is being developed by the Reserve Bank Innovation Hub. The platform is intended to be rolled out as a pilot project in a calibrated manner. It will have an open architecture and open application programming interface, that is API and standards, to which all financial sector players can connect seamlessly. This initiative will accelerate the penetration of credit to the hitherto underserved regions and further deepen financial inclusion in our country. Let me now conclude. We have made good progress in sustaining India's growth momentum. While inflation has moderated, the job is still not done. Inflationary risks persist amidst volatile international food and energy prices, lingering geopolitical tensions, and weather-related uncertainties. In charting the course of monetary policy, we continuously assess the impact of our past actions, the evolving inflation dynamics, and the implications of the incoming data for the economic outlook. I reiterate our commitment to align CPI inflation to the 4% target on a durable basis. We do look through idiosyncratic shocks, but if such idiosyncrasies show signs of persistence, we have to act. As we prepare to celebrate the Independence Day, the air is filled with hope and promise. Let me end by recalling the prophetic words of Mahatma Gandhi, and it is as follows. I have no doubt that our country would rise to the greatest height among the nations of the world. Thank you. Namaskar.
Okay.
Well, that was the RBI Governor Shaktikanta Das there addressing this August MPC policy meet, and what has come out of it, at least the highlights that we can give you. They are continuing to maintain status quo for the third consecutive meeting, we can say, and repo rate being unchanged. No much changes except for one that could be highlighted, a bit of change in their projections for inflation, right, Nandita? That's the only one that has come out from this meet as well.
That is there, but there is an incremental CRR that has been announced and which the markets haven't really reacted very positively to. In fact, the Nifty Bank, if you look at it, it is down, at today's low, somewhere around 0.5% down or thereabouts. In fact, even the markets have taken a sharp turn if you look at it. But if you look at the Q1 FY25 estimate for inflation, the expectations were that the RBI will increase it to somewhere around 4.7 to 4.8%, but it has been jacked up to above 5%. So that's one thing that I think the street has been disappointed with. But given the fact that we have seen such a sharp surge in tomato prices, and it has had a domino effect on other vegetable prices and pulses and other cereals as well. So the RBI is of course being cautious and vigilant when it comes to inflation. But on that note, let's get on board our guest for today, Stacey.
Yeah, that's right. We have with us, joining us right now, Aditi Nair, the Chief Economist and Head of Research at ICRA, as well as Saugata Bhattacharya joining us, the Vice President, Chief Economist of Axis Bank. Both of them, thank you so much for joining us and giving us your time. Maybe I'll come to Aditi first and ask her. Obviously, we've been saying this for some time now. This is on expected lines. We were already pricing in all of this, the hawkishness remaining there in Shaktikanta Das's address as well. How are we supposed to take this forward now, because pretty much everything factored in, even for the markets at this point?
Yeah, thank you. Well, definitely the policy and the tone were as hawkish as what we had expected, and I think appropriately so, given what the governor flagged repeatedly in terms of the idiosyncrasies that we are going through. And I think it was good to sort of highlight that while things may be idiosyncratic right now, and therefore we will look through them, that we do need to keep a watch out in case things start to become more entrenched. So I would say that we're in for definitely a period of rates being higher for longer. Based on what we expect from the inflation trajectory and what the governor said today, we think that there is a very low possibility of a rate hike at this point in time. But the expectations of the first rate cut, I think, need to be pushed forward given the 5.2% CPI inflation forecast for Q1 of of the next fiscal year. So given that, I think that definitely would push back when we expect any rate cuts to start. We have been looking at an average CPI inflation of 5.3% for the current fiscal ever since the tomato price surge started. And the MPC is actually coming at 5.4%. I'm wondering if that is basically to kind of, going with what the governor said, that we don't want to constantly keep tinkering with inflation rates. So maybe they've taken a bigger sort of uptick at this point in time to build in for any risks which may be there from the El Nino or from food prices remaining higher for a little longer than what we're expecting, even if the veg price spike is transient. So yeah, that was something that was a little different from our forecast, but overall I would say that hawkish in line with what we were expecting.
Aditi, hawkish in line with what you were expecting, and you said that the rate cut timeline would have to be pushed back a little further. So would you say first quarter of FY25, or would you say that it could actually be pushed to somewhere around second quarter of FY25 now?
First quarter of FY25 is where we were until now. But now with a 5.2% forecast for that quarter, and with again a third time in a row reiteration of moving to 4%, and that being the target that we need to move to, I think Q1 of FY25 is looking difficult.
All right, that's the view then. But let me also go to Saugata now. Saugata Bhattacharya, Executive Vice President and Chief Economist, Axis Bank. Good morning, Saugata. Good to have you on the show. What's your reading of the governor's tone? Would you call him vigilant, or would it extremely hawkish, given the fact that F125 inflation forecast has been in fact jacked up above 5%, which was contrary to what the street was expecting?
No, so yes, it was hawkish. It was expected to be hawkish because I mean they could not let any more financial easing occur in the market. Remember that financial easing has proceeded apace. I mean in terms of liquidity, in terms of equity markets, etc. So the one telling thing that I noticed right at the end of Governor's speech was the statement that if these idiosyncratic shocks persist, we have to act. So he was very clear. The other thing that I noticed, of course, I mean, Aditi's mentioned the food price situation. Our average inflation forecast for FY24 is 5.5%, a little bit higher than the RBI forecast. But what also came to my attention was the capacity utilization number that Governor mentioned, 76.3%, which also tends to indicate that core inflation might also be very sticky, very persistent. It's not likely to come down very quickly. And then thirdly, as you mentioned, the other little unexpected, although we should have seen it coming because the liquidity levels in the situation is much higher than I think what is consistent with a core inflation coming down. So you remember this is very similar to what they had done, RBI had done post the 2016 demonetization exercise, where they had taken an actual 100% incremental CRR for the amount in the system. Obviously, he was at pains to mention that this is a temporary measure, will be reviewed again in September, etc. But all of that, because I mean, too much liquidity in the system is not good for inflation. Too much money chasing the supply in the system. Also, given the fact that we have seen in recent times a tendency for the rupee to depreciate, also excess liquidity would be inimical to the rupee in a stable situation. So that's basically the sum of what I perceived from the governor's statement.
All right, Shaktikanta, hold that thought. We'll come back to you. Let me also get on board. Gaurang Shah of Geojit Financial Services is joining in. Gaurang, good morning. Good to have you on the show. Markets have, in fact, seen a knee-jerk reaction. In fact, the Nifty is just about managing to hold that 19,500 mark at the day's low after the RBI surprise announcement of incremental CRR. Nifty Bank also near day's low. So it's not really turned out to be such a non-event for the markets as as was being perceived, because everybody knew that there will be a rate pause. Everybody knew that the stance will be unchanged, and inflation forecast will perhaps go up a little bit. But it's as far as my reading goes, it's the incremental CRR liquidity measure that the governor has announced that has really weighed in on the markets. What are your thoughts?
Well, thank you very much, Nandita, for having me on the show, and morning to all of you all. So, more or less, as per the expectations that the markets had on some areas where the Honorable Governor has touched upon, I think that had possibly led to a little bit of disappointment. But this is the nature of the markets, Nandita. I mean, whenever an event unfolds, there is reaction depending upon which way the verbatim goes. I definitely agree that along with food inflation, there are two other factors which may possibly play a little bit of spoilsport, is the rupee dollar equation and of course the crude oil prices. If they stay elevated, especially the crude oil prices. Now, the data or the fine print is not available with me, at least as to what are the dependency in terms of imports from Russia and Iran. Barring that, I think this could play a little bit of hindrance. As far as the policy decision goes, well, the markets expected this, like I mentioned, barring one or two statements that the Honorable Governor has made, which has disappointed. But I would rather see it as a knee-jerk reaction from the markets to what the policy had to tell us. Possibly, we might see dust settling down by the time we wind up the trade today, or maybe early next week.
Right. Let me actually go back to Saugata and ask him to pick his brain about this whole ICRR being, banks having to maintain that at 10%. Why really this measure in place now? They are saying they're comfortable with the liquidities. Then why really take this stance at this point?
Well, remember that although they haven't RBI hasn't mentioned this statistic in recent times. Their idea of a neutral level of liquidity is about 1% of NDTL, 1 or a little bit beyond. So the current structural liquidity, durable liquidity, as they mentioned, seems to be easily about 2.5 to maybe even 3 lakh crores. To my mind, that to them given the fact that there are still remains inflationary pressures, and I have a feeling that you will see once the survey, inflation expectation survey, are published in the evening, that you will see that household inflation expectations have also increased, which is a danger sign to any central bank. So my sense is that and probably, I mean, they expect that some foreign exchange inflows still continue in the near term. So given all of this, they have a feeling that this liquidity and currency in circulation is not going out. I mean, cash outflows from the system has been very, very low this time around compared to the other similar periods of previous years. So given all of this, I have a feeling that they expect that this level of surplus liquidity is expected to continue for some time, and until inflation begins to again move down towards the 5% level that we have seen, and the forecasts indicate that they will like to keep liquidity lower than this. If, of course, and there is the other part that I believe that the government is very intent on increasing capex, both by the center and the states, which will also add to the system liquidity coming in the system.
Right.
So given all of this, I think that's the reason why you're seeing this measure.
Right. Aditi, if I may, get this discussion, make it a little more broader. We've seen a whole slew of downgrades that happen in the US with their banking system, especially. What are the kind of repercussions that we could see here, especially, now that there are these steps or these measures coming into place? So how are we seeing that play out here?
So just as a disclaimer, I work for ICRA, and the biggest, the promoter is Moody's, which is the global rating agency. So I typically will not comment on any rating actions taken by them or any other global rating actions. But overall, the situation does remain quite uncertain, and there is a lot of watchfulness that we need to have as far as any spillovers into our own economy and financial stability as well. I think right now, if we look at the overall situation as far as the banking system is concerned, there are many reasons to be quite positive for the Indian banking system as well. Credit and deposit growth are both quite high. And we do have this liquidity overhang, but as the governor said, the measure taken today is expected to be transient, and they would certainly be looking at reviewing it before the festive season. And, I don't expect that the RBI will want to take any measure that will sort of stave off the festive season demand or constrain sentiment at that point in time. So I think that is definitely something that they're going to keep in mind as far as looking at the incremental CRR measure today. We do expect it to be transient, and I think the markets have also, the bond market has shown a mixed reaction today. We've seen the 10-year yield going up and down. And I would still imagine that the 10-year yield, the GSEC yield, will probably remain in a band of 710 or maybe 715 to 720 in the near term. And of course, we have the new benchmark that's going to be issued as well.
Right, Gaurang, coming to you, since of course there has been an upward revision in inflation forecast, and for June, for the month of July rather, the figure is expected to come in somewhere around 6.8% or thereabouts. How do you think this surge in inflation in the second half, or in fact in the coming quarters, bode for the retail sector, the agricultural and consumer goods sector, given the fact that there was some respite in input costs that these companies saw? How do you think these companies will navigate the price volatility going forward?
Well, firstly, I think I would take a positive out of what the governor said, is that India is in a much more better situation to possibly handle any kind of unforeseen circumstances that may arise on fallback of higher inflation. Now that inflation could be related to vegetable, agri commodity, food grain prices, or possibly a better uptick on the crude oil prices and weaker rupee against the dollar. Having said that, Nandita, there is no way that you can avoid short to medium term external jerks that may impact certain sectors like FMCG or relatively dependent sectors which are focused on crude oil imports or based out of crude oil input cost. So that may have a relative impact over the short to medium term. But notwithstanding what happens, and looking at more optimistic statement that the governor has made about India being in much more better situation and place to, and eventually there is a clear and present danger, Nandita, with respect to short to medium term inflation numbers. But beyond that, I think it remains to be seen how we tackle it and where do we find ourselves at the end of the entire situation. If I have to look at all this, then I would rather take a positive out of what the governor has said. And as far as the inflation prices or inflation impact is concerned, it may have, maybe it may have a little bit of impact on the second quarter earnings if situation does not improve.
All right, that's the view then. But let me go back to Aditi and ask her about, the inflation projections for the month of July as well as August. Because right now what we are seeing is a surge in tomato prices, and it has had a domino effect on other vegetable prices as well. In fact, cereals, pulses, everything is getting expensive. Are you working with a figure under 7% for July, and for the month of August, would you expect inflation, retail inflation to, edge above that 7% mark, or would you say that 6.8 to 6.7 is the kind of expectation that you're penciling in for the next 2 months?
As of now, we are looking at July and August both being in the range of 6.5 to 7%. Even if they marginally go above 7%, I would expect a fair amount of retracement by September, October. And as of now, we do have the view that a lot of the shock is transient, so we will start to see numbers coming back down to more tolerable levels soon. But yes, in the immediate term, we do expect to see CPI inflation being in that 6.5 to 7% range, at least in July and August.
Right, Aditi, US CPI is due today. Of course, the expectations are that it could be around that. It could see some bit of acceleration both on a Q-on-Q as well as YOY basis. Even if there is some bit of acceleration, do you expect another 25 basis point hike when it comes to the Fed, or would you say that they are pretty much done with the interest rate hikes, and we could look at a prolonged pause from here on?
So I don't think we can rule out that there will be one more rate hike from the US Fed. That definitely still remains a possibility. But in addition to the inflation data, I think the incoming signals from the labor market are going to play a very, very crucial role in in the Fed's decision on whether to and when to actually hike rates going forward. So I think there the picture is a lot more fluid in terms of what would be the appropriate policy action. And I think we're not convinced that the Fed is done completely with the rate hikes. I think they're going to be quite watchful and vigilant. And today the RBI governor also used some of these words repeatedly. So vigilance, I think, is something that all central banks are going to exercise a great deal of, because they will not want to be in a position where they seem to have missed any signals and allowed inflation to rise. And today, in fact, even the RBI governor very much, put a lot of emphasis on the anchoring of inflationary expectations and not wanting to lose out on the good progress that has been made on that front because of the repeated food price shocks. So similarly, I think vigilance, even from the Fed side, does mean that there is always going to be a possibility that they can continue with the rate hikes. Of course, it may not be in every policy meeting, but I'm not sure that they're done as far as the cycle is concerned.
Right. Stay on with us, Aditi. Let me also bring in Gurmeet Chadda, the Managing Partner and CIO at Complete Circles Wealth Solutions. Thanks so much, Gurmeet, for giving us your time. You've already seen the numbers, and we've already seen how the markets are reacting to the RBI's decision here. Status quo, but also some tweaks coming there, which is hurting the bank nifty and those banking stocks. So let's talk about the rate sensitives. Those are the ones that pretty much react to the RBI's decision. How are we looking at those stock specific action that we are seeing right now?
So I think the market will take some time to digest this incremental CRR. I think got to do with that 2,000 rupee currency which came back, almost 88% came back. I think the back of the hand calculation could be basically 80,000 to 1 lakh crore. So it isn't much, but since the bank NIMs post the result of SBI and few banks, there have been some concerns by brokerages on NIMs contracting, peaking, and now coming off. This is slightly, and that's the reason you saw some reaction. Bank Nifty, it became positive when the announcement came, and then with that incremental CRR. But I think it's a temporary measure. Also, it doesn't really impair the ability to lend. The credit demand still remains in healthy double digit. So I don't see that as a serious impact, but some concern obviously comes. And second is the inflation data. I think probably the street was expecting slightly lower, 5.4, maybe incrementally slightly on the higher side, which means any hopes of any reversal, in rate cycle gets delayed. Market works on discounting the future. So I think those are the two things I think which market will. But I don't see much reaction. I think we have been worried more had the bond markets reacted more violently. The 10-year is broadly stable at 716. And I think that's what we need to monitor. If bond yields remain stable and well anchored, I think we should be okay.
Amit, you spoke about margin pressure for banks, of course, as deposits are still getting repriced and the transmission rather is still happening. But after the first quarter earnings, what are your thoughts on the entire PSU banking lot? Because SBI did disappoint when it comes to margins. Contraction of 37 bips was something that the street wasn't really working with. Do you think margins will remain a concern for the coming quarters for most of these banks now?
Good. Because they expanded when interest rates went up, because as you rightly said, deposits get repriced with a lag, and once the rates stabilize, the catch up happens. But I don't see for PSU banks NIMs really coming below 3.1, 3.2. Let's say if I were to speak of SBI, I think should remain +3 at least for the larger lot. I think what also disappointed the street was the incremental credit growth, especially since you mentioned SBI and PSUs, was just 1.1%. But I think the chairman did guide for 14-15% credit growth. So I'm not particularly very concerned with it. I think there is credit creation happening. There are new lenders coming in the market, which is digital as well as these small finance banks and NBFCs. A lot of investors who did not have access to formal lending are getting into the net. I think Geo Financial will further drive this. So I don't see much issue as far as the credit demand goes. I think it's pretty resilient. And I am of one of the opinion that the investment cycle is now beginning to play, and this is usually more long term and structural. But yes, I think in terms of price movement, I think since Bank Nifty has been an outperformer, some bit of consolidation can definitely happen. And PSU banks, the valuations are comforting. So at one book value, let's say for SBI and Bank of Baroda, also slightly below one book value. Some of the negative probably would be the price.
Gurmeet, I also want to get your thoughts on the auto pack. Two-wheelers, of course, remain in a spot of bother due to the rural demand not seeing the kind of recovery that we would have anticipated. But we've seen some sort of recovery in tractor demand and tractor sales as well. But especially on the two-wheeler basket, how would you view stocks like Bajaj Auto, Hero Moto going forward? Do you think this will remain remains a kind of a blip when it comes to these stocks?
Two-wheeler numbers are soft. Got to do with the rural economy. Also, it's one of the parameters there. So if you see, for example, Hero sales, in fact, entire two-wheeler sales is still less pre-COVID, while the passenger vehicle sales has crossed and CV sales is almost now matching up. So we are more constructive on the passenger vehicle side, because there it is healthy demand. So if you see M&M, the outstanding bookings are about 280,000. Tamo seems to be doing very well with JLR as well as PV and commercial vehicles, all three cylinders firing. M&M also, there is valuation comfort at about 15-16 times. Market obviously got a little perturbed with the decision to buy stake in RBI. So passenger vehicle, there is demand. Second, chip shortage situation is slightly better. Raw material inflation has come off, and overall trend is pretty positive. So that remains a preferred play. And also some of the auto ancillaries, if you map the value chain correctly. Two-wheelers, I think one company which has stood out is TVS. It's also because of their top-selling models doing very well, which is Raiders as well as Apache, and the EV, which is iQube. Now they're already talking of 20,000 units plus wholesales. The margins have come back from 6 to 12%. So I think maybe the second half of the year, when government does a little more as we approach state elections, probably there could be some recovery in two-wheelers, but broadly more constructive on passenger vehicles and CV space.
Right. Let me go back to Saugata and get a little broader perspective from him as well. We've been seeing these numbers, a macro perspective, the macro numbers, CPI numbers rather, from China that came out just yesterday, wherein they are almost staring at a deflation, one would say, and then you're anticipating a slightly higher number from the US as well, somewhere between 3.3 instead of the 3% that they recorded earlier. So overall, central banks are really working with what inflation is telling them. We are seeing mixed different kind of reactions where, you know, the West is really going ahead and hiking rates, whereas you have to take a different kind of measure when it comes to what China is doing. And in India here, we're choosing to play that wait and watch game. So what are we really looking at central banks doing, and is anyone taking cues from the other, if you have to take that into perspective?
No, so India RBI has to take a cue from both the G10 central banks, particularly the Fed, and now increasingly from even the People's Bank of China, because People's Bank of China, although their response, stimulus response, has been much more muted than people had expected. There is a worry of the CNY, the Chinese yuan, the RMB, weakening even further. Because if the RMB weakens, that will take down the entire EM basket of currencies, including the rupee. So that also is a problem. But my own sense is that the Fed is probably close to the peak, to the terminal rate, as Aditi also mentioned, maybe one more. Markets seem to be expecting them to pause in their September policy meet. But maybe one more in November, and then they are done. The ECB will probably have to do two more. So, I mean, central banks are nearing the peak. So, which is good news for the RBI, because that reduces the pressure on the rupee. Because, I mean, otherwise they will have to act on liquidity, on rates, etc., to maintain a stable rupee, on the stability in the external sector. But for the Fed, the basic problem that we see is that it's not just the inflation, it's their unemployment rate, the labor markets. Research seems to suggest that even a 4%, right now it's 3.5%, the US unemployment rate, even a 4% unemployment rate is inconsistent with a 2% inflation. So that's their headache, because in those economies, particularly with tight labor markets, a very rigorous wage price inflation cycle, a very vicious cycle of wage prices moving with each other, that is the biggest headache of any central bank, and that's what we will be watching for.
Coming to you on the rally in crude prices, of course, crude has hit a 2023 high and somewhere around $87 when you look at the Brent. But, you know, at least in the last policy, I think the RBI was working with somewhere around $85 or thereabouts. But now, when would you say that crude is slowly inching towards that $100 mark, and, you know, we will be looking at that level to be hit sometime soon? And if that happens, would that be a renewed headache for RBI?
Is that for me? Sorry.
That's for Aditi.
You know, I really did feel for a large part of this year that crude oil prices were not at a sustainable level. I thought they were a little bit on the lower side, given the fact that the output response can always be there to demand a flagging in certain economies. Now, my view is that 85 to maybe 90-95 is probably a band that we need to be ready to live with. I'm not sure that $100 is something that can sustain. We can have short-term spikes, but I'm not sure that the global economy is going to be able to absorb oil at $100 per barrel right now. But the sense I have is 85 to 90 is, you know, possibly something that is going to be more likely in the near term. We are heading into the winter shortly as well in the northern hemisphere, when prices do tend to be a little bit higher. So for us, for the Indian economy, we would have to kind of be ready with some sort of contingency planning for at least an 85 to 90 kind of a band, if not slightly higher than that as well, for a limited period of time. But for monetary policy, I mean, you know, this is definitely something which is quite exogenous. Prices moving up and down depending on supply and demand in different parts of the world. And I mean, my personal view is we cannot keep having to react to changes in crude oil prices, especially when they don't represent any domestic supplier demand changes. But yes, it is something that does affect a large part of the WPI basket, smaller part of the CPI basket, or at least more slowly. Because petrol and diesel, unless the administered price, unless the pump price is changed, that at least doesn't enter the CPI. Crude oil is not part of the CPI basket either. But all the other non-administered, freely floating crude oil related prices, the derivatives, petrochemicals, etc., those will transmit very quickly into the WPI basket and relatively more slowly into the CPI basket. But of course, the impact would be there on margins as well. And this is something that will start to feed into the overall CPI dynamics over a period of time, as well as on the margin side. So it is something that the RBI will have to remain watchful of. But yes, personally, I do feel that 85 to 90 is definitely a band that our inflation projections and expectations need to be consistent with.
Right. Let me bring in Gurmeet again and get his view on the Nifty Realty or the Realty pack as a whole. We've been seeing those stocks do quite well. Most of these realty stocks have been, getting good returns if you look at them on a longer term base. And in the past few days, they have come under pressure. So how are we supposed to look at the Realty pack at this point?
So there are two pockets essentially. One is the developers, and second is the entire building material and home improvement play. I think in developers, Q1 was slightly soft, and you have to go probably geography wise. So DLF, for example, after a good year, there were no new launches in Q1. So they were liquidating the inventory, which was still good considering they liquidated 2,000 crores plus. But considering that what they have in pipeline, I think 15,000-16,000 crores kind of pre-sales should be met. Similarly, for some of the, the MMR, which is including Macrotech and others, and some of the South ones also are doing well. And there is balance sheet discipline now. I think the impact of RERA is now getting visible, both in execution and in balance sheet. If you see the net debt levels for most strong corporate developers, but we are more gung-ho on the entire building material space. So that's where probably you get better return ratios, better cash to generation. So we were lucky in Polycab, got in early. We like some of the tile makers like Kajaria. Also some of the sanitary ware makers. We are also seeing now consolidation in cement with Ambuja buying Sanghi. So a lot of small cement guys are in focus because some of them actually trade at $50-$60 a ton. And the recent deals have happened around $90 to $100 a ton. So some of them are actually below replacement cost. So some action there as well. So that's the space we like more, the pipe makers, the tile makers, etc., versus the developers. And I think the demand still remains robust, both for the new homes as well as the broader home improvement theme playing out.
Since you're here with us, I want to get in your thoughts on the entire pharma pack. Of course, it has emerged as a dark horse, so to say, given the fact that, it has the index is up somewhere around 20% on a YTD basis. And we've seen the likes of Cipla and Dr. Reddy's stage a very smart recovery. Promoter stake sale buzz keeping Cipla at record highs. Dr. Reddy's has hit a fresh record. How are you viewing the entire pharma basket? More upside, and how does the second half look for some of these stocks?
So, there was some value buying happening because, if you see Nifty pharma weightage went down to 4%, just 4% of Nifty, which was even less than HDFC Bank pre-merger. So was hugely underrepresented because of the negativity around it. And same happened a little bit with IT also, although the IT catch-up is still some time away. I think you have to dissect the pharma into 2, 3. So I think if you see in India, the medicine prices are not very high if you compare to the West and even emerging markets. So I think we are more gung-ho on medical services, something like hospitals, etc., which I think is now beginning to look very good. And there is some discipline which has come in terms of asset creation. So if you see, for example, Max, now they are more focused on Delhi and Mumbai. If you see, Medanta, Apollo after launching assets all across is again has more targeted strategy. So hospital is one segment which is good. There are some niche plays also, which is child pediatric care, etc. So that looks good to us. Branded pharma, generics, India-focused plays look better. Cipla obviously is one. There's a bit of an overhang now with the Pithampur plant seeing OI. But, you saw a stellar listing in Mankind Pharma also. The stock has done really well post-listing. So branded pharma looks good. And one space which is more for long-term, not for the second half, 4 or 5 years, is the CDMO space. So there are a lot of molecules in stage 3 right now. And this pharma outsourcing looks to a very, very big opportunity. But this is a lumpy business. So if you want to get into this, you have to have a longer
Right.
period, and you should be okay with near-term drawdowns.
All right, hold that thought, Gurmeet. Let me also bring on board Lata Venkatesh, joining in live from the RBI headquarters. Hi, Lata. Thanks a lot for joining in. The RBI did stick to script when it comes to rates and stance, but the incremental CRR came as a negative surprise. What are your thoughts?
Yes, the incremental CRR is negative for banks, but it's, only 10%. And only on the incremental money that they have got after the 2,000 rupee notes started coming in. It will be reviewed on September 8th or something in the next policy, that is. So I don't think it's going to be a huge impact. It's a very, very marginal impact, but yes, that impact is negative. On the statement itself, the way the bond markets have reacted, the yield went up to 7.17 and then came down again. It looks like the bond markets have not treated the policy as very hawkish. Yes, the inflation projections, forecasts for the current and the next quarter have been raised rather substantially, but the market was prepared for some kind of an increase. The bond markets have not seen it as more hawkish than expected. So that's why, after the initial knee-jerk reaction when the inflation numbers were announced, the bond yields have cooled off by 1 basis point. Even the Nifty Bank, after a slightly negative reaction, is now down, but down about 0.5%. So my sense is net, not all that negative, not as hawkish as expected.
Lata, could you also just elaborate a little bit on how these bond yields are really going to change further, because this was perhaps a knee-jerk reaction, but are we going to see more action in the bond market from here on?
You will see a lot of reaction in the shorter part of the bond curve, which we only look at the 10-year bond yield. But the T-bills, you could see yields rise simply because there is a little bit of tightening of money. Banks have to put away a little more of their loose cash as CRR. So they will be borrowing that money from the call market, and therefore near-term liquidity becomes tighter. There won't be much of a reaction on the longer part, on the 10-year bond yield. As you can see, that's softened a bit. So net, it's not a big reaction at all. Near-term money is tighter. If you're borrowing for 1 week, 1 month, 3 months, those yields have gotten a little sharper, a little higher. But the rest of the curve, the markets have taken it very calm.
Right. Well, thanks so much for that, Lata Venkatesh, joining us there from the RBI building itself. But with that, it's a wrap. Hope this was informative and we gave you all those nitbits of the details that the RBI policy really came out with. Thanks so much for tuning in.
Thanks a lot. Stay tuned to Moneycontrol for all your other news and updates.